Howdy! Let's take a closer look at the treatment of manufacturing overhead. KA Catering uses a job order costing system to assign costs to its catering jobs. Overhead is allocated to each job based on direct labor hours. Listed below is data for the current year. Budgeted overhead cost, $90,000. Actual overhead cost incurred, $77,000. Budgeted labor, $100,000 for 10,000 hours. Actual labor, $95,000 for 9,000 hours. So here we have a case where we know what the company thought would happen at the beginning of the year and then what actually did happen throughout the year. So we've got a complete picture. First, we'll determine the amount of overhead applied to work in process during the period. In order to do that, you have to first compute the predetermined overhead rate. Notice the word predetermined. This means that the overhead rate is going to be based on budgeted information. The formula we learned previously is you take the budgeted overhead costs and you divide by the budgeted activity. Now you'll notice that it says that overhead is allocated to each job based on direct labor hours. This is important information because it tells us what our denominator is going to be. It's going to be direct labor hours. So we were given that budgeted overhead costs were $90,000 and budgeted labor was $100,000 for 10,000 hours. And of course we're going to use the hours since that's how the company applies overhead. So plugging in, we'll take $90,000 divided by 10,000 hours and we'll get $9 per direct labor hour. So this company believes that as every labor hour is worked, they incur labor costs, but they also incur overhead costs. Electricity is used. A space needs to be rented. There needs to be a supervisor. So they believe this occurs at a rate of $9 for every direct labor hour worked. Now that we have the overhead rate, we can use that to assign overhead costs to inventory. Now remember, we do that by taking the predetermined rate but multiply by actual activity. So the formula is overhead applied is equal to the overhead rate times actual activity. So as labor hours are worked throughout the period, we assign costs to the jobs. All right, we were given that actual labor costs were $95,000 for 9,000 hours. But since our overhead rate is $9 per labor hour, we're going to multiply by the 9,000 hours. And that's going to give us overhead applied of $81,000. So this is how we would assign costs to the work in process inventory account. $81,000. Next, we'll show the adjusting entry to close the overhead account at the end of the period. So companies will calculate a predetermined rate, assign overhead costs to inventory throughout the period, and then they will close this overhead account to zero at the end of the period before they prepare financial statements. So anytime you're asked to close out the overhead account, a good thing to do is just to set that T account up. And remember, actual overhead costs are recorded on the debit side and applied overhead costs are recorded on the credit side. That way you're keeping track of what overhead costs were actually incurred and what overhead costs were assigned to inventory. So we were given the actual overhead costs are $77,000. So we'll put that into our T account. Notice that we did not use the budgeted overhead cost. The only place that is used is in the predetermined overhead rate calculation. Now in our first calculation, we determined that applied overhead is $81,000. So we can see based on this that we have a $4,000 credit balance. That means that we assigned $81,000 to inventory, but we only incurred $77,000 of cost. So we have over-applied overhead. We've over-assigned costs to our inventory account. So the journal entry to close that out, if we have a credit balance in overhead, we are going to need to debit manufacturing overhead for $4,000. This will get this account to zero. We will assume this amount is insignificant or immaterial in amount, so we will close it to cost of goods sold. We will always close the overhead account to cost of goods sold in this class. This essentially reduces the cost of goods sold account since it is an expense account. Assume 2 jobs were sold during the period. Job 10A costing $200,000 and Job 12B costing $100,000. What is the cost of goods sold before adjustment? What is the cost of goods sold after adjustment? So before adjustment, we take the cost of the 2 jobs, $200,000 and $100,000. So cost of goods sold before adjustment is $300,000. Now after adjustment, we will have to consider the $4,000 of over-applied overhead. And since we over-assigned cost to our inventory, we will reduce our cost of goods sold. So cost of goods sold after adjustment is $296,000. This is what will go to our income statement for cost of goods sold. Right, that's the end of this problem, so make sure that you do your homework related to overhead and bring questions to class. See you then.